Good evening. Welcome to the webinar. Today we will talk about the banks, what banks can offer us, about challenges when we work with banks, about the surprises that may await us on our way. I would like to start with disclaimer. Information is made available to you as self-help tool for your independent use and not intended to provide investment advice. So what do I mean by this? So all information here is correct, but please make sure when you are doing your own mortgage, speak with professional, speak to somebody that you trust, and get your personalized advice. Please use top chat, and you can send messages here. So I will put like hi, I will send hi, ask them through the webinar. Okay, please use chat here below to ask questions that you may have. Also, if you paid attention, we have a question mark here in the corner. Every time that you see question mark, it means that I will stop, I will take a pause, and I will wait that you will write something in the chat. Maybe you will ask more questions there. So I will, so you can put smiles, you can send something here. Okay, so I will send a smile here. Again, we are going to start, so please use a chat to ask your questions. So I would like to start with bona fide sale closure. So some of you may know, but majority of us is not even aware about this. What is a bona fide sale closure? When you purchase a home and you have a mortgage on home, sometimes some banks may come with discounts, but these discounts comes with a price. If in your offer from the bank put condition that call bona fide sale clause, you cannot pay out or break your mortgage before the end of your term or unless you sell your house. It means you can't do any renewals, you can't get better rates in the middle of the term, you cannot refinance, so you're kind of stuck. Here is an examples of several banks like BMO, CMLS, MCAP, Motus Bank. Also other banks have this type of mortgages. So please be careful when you work with these banks, because it may mean for you that you will not be able to do any changes. So in order it will be clear, it means like, for example, you go to the bank give you, for example, rate 4.4, you're happy, you sign documents, you go say, and on this account you have money for several days. Bank actually will look on your transactions, and every transaction that $1,000 or more will be checked. How bank usually checks this transaction? Bank asks a lot of questions. From where this transaction come? How this money arrived to the city, how this money were accumulated, 1,200 on checking account. So basically, instead to present just last 3 months from the saving account, now bank wants to see what happened on your checking account. So if it happens on August, so they want to see 90 days prior, so you need to show July, June, and May. So one small transaction, around $1,200 or anything that 1,000 or more, can and banks will ask for more documents, for my paperwork. So before I start to talk about mortgage default insurance, I just quickly check if we have any questions here. No, I don't see any questions here. And again, I would like to remind that please ask your questions. It will be great if you will ask as much question as you can. Okay, don't hesitate to ask any questions. So let's talk about mortgage default insurance. So you maybe know that everyone in Canada who purchases home and person doesn't have 20% down, so his down payment less than 20%, let's say 5%, 10%, 15%, even 19%, this person must purchase mortgage default insurance. This insurance insuring bank, and this money you basically will pay together with your mortgage. This insurance will be added to your mortgage. Government of Canada would like to help people to purchase houses. So prices of the houses increased last years. So the maximum house that was able, like if you were going to purchase house that cost $1 million and or less, you were able to use mortgage default insurance. Now, after December 15, a new change. So now houses up to $1.5 million, you will be able to use mortgage insurance. So for example, if before somebody wanted to buy homes that cost $1.5 million, government was expected that person has 20% down or $300,000. Now it's not a requirement because person may use mortgage default insurance, and for house that costs $1,500,000, minimum down payment will be $125,000. So this is a new change, and not like banking not really talking about it. I saw this in like some news, like started to talk about banks still moving slow, not really implementing it, but I believe after December 15 or probably after Christmas, or let's say June 1st, 2025, it will be not a problem to use this program. One more thing, and is also important. You probably heard that since August, people who are buying new properties can use amortization 30 years. So instead 25, 30 years. Why it's good? For some people, like it's good because mortgage payments will be smaller. Like if you take 30 years, mortgage payments is smaller. So some prefer smaller mortgage payments. And smaller mortgage payments, it means you will be eligible for a little bit bigger mortgage amount. Let's say you were approved for $100,000 mortgage, so now you will be approved for bigger than $100,000. I cannot provide exact numbers, but it will be definitely bigger because your amortization will be instead 25 years, 30 years. So for some clients who, for them, if it's really critical, like let's say they pre-approved for 320 and they want 340, so maybe they need to wait until January and use this rule for 30 years, because it will, everyone who is buying home like first time home buyers, they will be eligible not just for 25 years amortization, 30 years amortization. So you can see a question mark here in the corner. So I'm going to check if maybe someone asked questions. Okay, I still don't see any questions here. So I am going back, and yeah, I just will write here, please ask your questions here. As you know, I'm speaking several languages, so if it's difficult to type in English, you can type in your language. Oh, okay, I already can see some questions. So one of the questions here, what is a mortgage amortization? Okay, So what is a mortgage amortization? Mortgage amortization is the maximum years that you can get a mortgage. So, for example, I go to the bank and I would like to get a mortgage. And a standard in Canada is 25 years. But now a government wants to do change. So a standard will be 30 years. It means if you go to the bank to get a mortgage after December 15, you can spread your mortgage or you can spread your mortgage payments for 30 years. Contract with the bank will be just for 5 years or 4 years or 3 years. We call this term. So mortgage term can be 1 year, 2 years, 3 years, 4 years, 5 years, 7 years, or even 10 years. So in Canada, we have term, so it's a contract time, and we have amortization. Amortization is the general time or life of the mortgage. So some people say, oh, I would like to pay my mortgage in 15 years. So if you won't like to pay off your mortgage in 15 years, your contract can be still for 5 years. Your amortization can be still for 30 years, but you can pay off your mortgage in 15 years. And you're doing this by using prepayment privileges. What is the prepayment privileges? So bank will allow you to pay off your mortgage faster. Not every bank allows this, so it's also you need to check what bank allows, what bank not. I am as a mortgage professional can guide you and help you to pick the right bank. So if you need to pay off your mortgage faster or want to pay off mortgage faster, we can discuss it, how to do it. Another question, what advantages of these changes? So first of all, what is, like if I live in the small province and I am buying something for 400, 500, 600, 700, I don't really feel any advantages. But if I live in Ontario or BC and my condo that I like cost $1,200,000, $1,300,000, before I was expected to bring 20% down payment. Now I don't need 20% down payment. I can buy with 5% for the first $500,000, and for the rest I can bring 10% down payment. So my down payment will be much more lower, and it's very important for people who live in Ontario or other provinces. Or I can provide another example. Let's say you live in Alberta, and let's say you purchase a home that cost $500,000, $500,000. And after 3-4 years, you got better job in BC and you decided to move. So you can basically sell your home and transfer your insured mortgage to the new home. And if new home cost more than $1 million, now you can do it. I have an example. I have a client, they purchased a condo that was cost less than $1 million in Ontario. And they wanted to sell a condo and buy a home that costs more than $1 million. So if they are doing it now, they must pay off their mortgage completely and take new mortgage, completely new mortgage. And of course, when you break contract and you break one mortgage and you take another one new mortgage, you need to pay penalty. So it's not good. But now, or not exactly now, after December 15, let's say you purchase condo for 700 and you worked hard and you now make much more money and you have much more savings and you want to sell your condo for 700 and buy maybe home for $1.5 million, you can transfer your mortgage from the 700,000 to the $1.5 million to add to this mortgage new mortgage, use old insurance, add new insurance. So basically you save a lot of money. So all these new laws they're basically helping people save money, especially if they live in the provinces like Ontario or BC, or even smaller provinces, like smaller I mean by population. If you look even in Saskatchewan and you want to build really big house, maybe multi-family house, like for example you want like several generations will live there, like grandparents will live there separate, and parents will live separate, and children will live separate. Like this big house will have 3 different entrances, and maybe even have another entrance for tenants, and this house can be big, like 3,000, 4,000 square feet. And this house probably will cost much more than $1 million. And question, if before this type of house to buy you need 20%, and it's a lot of money, now you need 5% only for the first half million, so $25,000, and 10% for the rest. Okay, so these laws should and will help. Okay, let's continue with our presentation. I don't see any other questions here. Credit profile. So let's talk about credit scores. A lot of us know that we need to have a good credit score, and our banks provide option to see and check credit score. So like Bank RBC, TD, Scotia, you can check credit scores there. But a problem, this is usually internal or TransUnion score. So is it good or bad? No, it's not a good or bad, it's just different score. So if I want to get a mortgage and I want to compare between several banks, not just bank where I'm right now, I need to use more advanced credit reports and more advanced credit scores. So I personally recommend to use, for example, Borrower, because it's connected to Equifax, or use Equifax directly, because all banks work with Equifax, so you will be more competitive, so you will be able to compare between banks. Because, just simple example, let's say you score 620, and let's say this is a score that you see at Scotiabank. 620 score at Scotiabank, it can be 620 Equifax, but it also can be 570 with Equifax. And it means that you still can get a mortgage with Scotiabank because you have a score 620, but you can't get a mortgage in another bank because your Equifax showing score below 600. Minimum in Canada you should have 600 in order to get a mortgage. So I strongly recommend or use Equifax or Borrower, so to check your credit profile and check your credit score. What is else important? So every person recommended to have 2 credit cards, and if it's hard to have 2 credit cards, at least 1 credit card, and this credit card should be from your bank. Okay, not credit card from store, any store, like doesn't matter what store, Walmart or Canadian Tire or Superstore, it doesn't matter what store provide you a credit card. Your first credit card must be from your bank, because your bank will report your credit bureau regularly, and you will be able to build good credit much better than with any other store cards. So please get a credit card from your bank. How much you can spend from your maximum? Your maximum spending must be under half. Like in my recent presentations, I was always talking about 30%. Yes, 30% is just perfect, but it's hard to manage. You can go up to 50%, and it's okay, it's fine. So let's say your credit card is $2,000, you can use up to $1,000, like up to the half, and you will be okay. But please don't cross $1,000, it's not good. Try not to use cash for any transactions, especially if it's about the rent, utilities, or any other services. The most popular or common error, people going to get phone, husband and wife getting a phone, let's say wife getting a phone for husband and herself, and she is paying for herself and for the husband. Her credit history will be very good. Why? Because she is paying on time her phone will be on her credit history, she will get points, husband will not get any points. So please, 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 I know sometimes they giving discounts. Discount is important, but especially if you're new to Canada, husband should have his own line and pay separate, and wife should have her own line and pay separate. You can add children to husband or to wife, it doesn't matter, but if your child 18, your child is strongly recommends that your child will have his or her own phone line, because phone line reported separately on credit bureau. What is the magic number 2? $2,000. So $2,000 is the magic number 2. Credit card must have minimum limit $2,000. If your credit card has limit $500 or $1,000, ask bank if they can increase your limit, or just wait. Bank will call and ask increase your limit. If bank calling you and asking, can we increase your limit? Always say yes. Increase your credit limit as much as you can is good for you. It is not affecting your mortgage application or your application to buy car or anything. The more credit card limit is better for you. So what is a credit card invisible limits or traffic light? It's like you go with the traffic and you see red sign, it means stop. So 54% of $1,000 half from your credit card, it's a stop. You must stop spending. You must stop. Otherwise, you will get penalty. Officer will come from credit bureau and will take points from you. Okay? But if I'm going under 30%, I'm spending under $600 with $2,000 card limit, it means I'm good. I am good driver, I am passing on green. But what happens if I will pass on yellow? No one will penalize you. Your credit score maybe will not grow fast. Your credit score may lose 1, 2, 3, 5 points. It's not really very important. It's just several points. So yellow, it's exactly like with the driving. If you pass on yellow, it's still okay. It's not the perfect, it's better to drive on green, but it's still okay. But please, please don't cross on red. What is another magic number 2? It's better to have 2 credit cards. So let's say you have 1 credit card and you have car loan. It's already 2. It's count as two different types of credit. So you don't have to go and take or get another credit card. Or in general, if you have just 1 credit card, it's fine. You will get a mortgage, don't worry. Some people say, oh, I want my credit score will go fast, or I would like to repair my credit score. Let's say your credit score 500. You need to repair your credit score. In these cases, you must have 2 credit cards. Okay? So if your credit score under 600, you must have 2 credit cards and you must use them properly. And what is in number 2 years? 2 years is usually a normal time frame takes your credit score to build up. But honestly, if you just arrived to Canada and you have 1 credit card and you use it properly, just in 3-4 months you already have score more than 600 and you can go and buy property, so it's not a problem. Why I put 2 years anyway here? Sometimes if you're in trouble or you're getting score like 500 or even 400 or 300, in order to repair score, it takes usually up to 2 years, but it doesn't have to be 2 years. It's up to 2 years. So magic number 2, it means credit card must be at least $2,000. Use 2 credit cards if you can or if you want. Of course, minimum 1 credit card you must have. Always drive green. You can drive sometimes yellow. I am fine and you will be fine, but please be careful. Never cross on red. Always stop. And if your credit score is not good, probably it may take a long time until you will repair. The fastest way to repair, get 2 credit cards with $2,000 limit each or more. Okay, now I would like to see if maybe I get more questions. Okay, I don't see any more questions here, so I move forward. I will send another smile here. It means I would like to see more questions, and it's great to see your questions, guys, okay? Thank you very much for participation, and please ask more questions. So this question mark means that I'm answering questions, but because I don't see any questions, I will wait another second or two. No, we don't see any questions here, so we can move forward. Let's talk about the income. Many people don't know that it's not just any income eligible for mortgage. Some people work very hard, but their income not eligible. For example, if you have temporary position, this income not eligible for mortgage. If you have seasonal position, like if you can see in my example, salary, variable income, seasonal, it means your income will change. It will be variable. Sometimes you will make a lot, sometimes you will make not too much. Bank in these cases wants to see 2 years. You will need to wait 2 years before you apply for mortgages. So 2 years, bank will check your T4s from your income, T1. T1 general, it's a document that usually prepared by your accountant. You can do it by yourself, but it's much more easy to get accountant to do this job for you. It's not cost a lot. Notice of assessment, this is a document that you will receive from CRA. 2 pay stubs is normal, is standard, and letter from your employer. So sometimes if you work seasonal, you need to wait up to 2 years before you can normally apply for a mortgage. But if you, let's say, less than 2 years, you maybe still can apply. In these cases, it's something special, some specific. I need to look on your documents and I will help. Like how I can help, I will be able to analyze your documents, and in some cases we can apply for a mortgage and we don't need to wait for full 2 years. But it definitely will be like at least year, like let's say year and 7 months, 8 months, something like this. In the first example, I put salary fixed income. Majority of people, salaried people, as soon as they get jobs, they usually have 3 months probation period. Even if you don't have probation period at your new job, usually bank want to see that you're stable during these 3 months, and bank wants to see that your hours guaranteed. Bank does not really care if it's full-time 40 hours, full-time 50 hours, or maybe it's even part-time 30 hours. Won't bank care if your employer guarantee hours, or your employer can say this person works at least or minimum 30 hours. In these cases, bank just want to see that you work in 3 months. If you consistently work in 3 months, if you work no less than 30 hours, all your hours can be calculated and used as your income. Of course, you shouldn't be on any probation. Probation is kind of trial period. Some employers have probation periods. I even saw employers that giving probation for a year or 6 months. But kind of majority employers, if they put person on probation, it's kind of standard 3 months probation, kind of trial, and after that person is like permanent with this employer. I just quickly check if I have any questions. No, I don't see any questions, so I am returning. And my next is also about income. Alimony is when you separated and your husband or your wife paying you certain amount, and this amount deposit in your bank account. Let's say husband and wife separated and wife paying to husband $300 monthly. If you can prove and you have separation agreement signed by a lawyer or done with a lawyer, and this agreement says that your wife should pay you every month $300, this $300 considered as income. If you have a child, usually in Canada is wives apply or women apply for Canada Child Benefit. If you're on work permit or just arrived to Canada on work permit, you usually need to wait 18 months before you apply. You wait 18 months, and after that you apply and you will receive Canada Child Benefit. And banks usually check in that you have regular deposits in your account from CCB, and they want to see birth certificates or passport of your children just to confirm that it's actually your child and this child has age eligible for these benefits. Like in Canada, you're eligible for Canada Child Benefit up to 18, but when you take a mortgage with a bank, banks understand that your term will be like, let's say 5 years. So bank says, if your child already 16, 17, probably they will not take this in an account. Majority banks want to see your child is less than 15 or up to 15. So if your child is already 15 and you still receiving Canada Child Benefit, you will not be eligible to use this as an income. But if your child 14 or less, you will be able to use this as an income, and sometimes this helps significantly to get a much higher mortgage amount. Another interesting trick, that if you will go to your local bank and you will say that you are pregnant and you are going to have a baby, and your boss promising to return you back to the work, so bank would like to see proof that you returning to work. But the problem, when you're on maternity leave, you're not receiving a full amount. Let's say you make $2,000 bi-weekly, okay, $2,000. So if you go to your local bank, they probably will say, okay, because you will give a birth and you will have a child, or you just gave a birth, you have a child, and you're on maternity or parental leave, like let's say your husband sit with a child at home. So in this case, bank say, oh, okay, it was 2,000, no. I will calculate just base like 1,000, like only 15%. So in these cases, I strongly recommend to speak to somebody who is a mortgage professional, because the secret is, or something that your local bank probably will not tell you, that some banks, especially monoline banks, they have option. So even if you're at home and you're not working, they will calculate your income based on your return income. So let's say you was paid $2,000 bi-weekly. Now you're at home with a child and you pay just 1,000, but your employer give you a letter saying you will return in a year back on this and this date, and they will continue to pay you 2,000. these monoline banks will consider full 2000. So this is an interesting fact. So I hope, yeah, and I put it here. Yeah, so if you expect it to return to work in fewer than 12 months, some lenders, monoline lenders, will consider full 100%. Yeah, so I would like to see if maybe you have any questions here. Okay, so I have a question here about the job letter. Okay, so let's say we get, so here is a question. So job letter says that person make 40 hours weekly, okay? So 40 hours weekly, bi-weekly it's 80 hours, and last 4 weeks is 160 hours. Okay, so job letter says I pay bi-weekly, this person guaranteed to get 80 hours. But when person provided pay stubs, when we open this pay stub, we can see that it's not 80 and 80. Let's say 73, 50. So in total 73 and 50, 123. So it's less than 160. So it's a huge difference between what this letter says and pay stubs. So my first move, like if I will see these documents, I will ask, what's the reason you didn't work 160 hours? And if person say me, the reason I took vacation here, I took day off there, my child was sick, I took some time off there, I went with my husband for anniversary here, but usually I work normal. So in this scenario, we don't need to worry, and bank will calculate full 160 hours, because bank is not like, like they are kind of robots, but they are flexible robots, okay? In this scenario, bank can be flexible. Maybe some banks will not be flexible, but majority of banks will be flexible, and it will be calculated based on 160 hours, not less hours. But if bank, let's say, call your boss, and bank every time calling to check whatever it says employment letter. So whatever, it doesn't matter who will give you employment letter, your boss, HR manager, it doesn't matter who give you letter, bank always call to the person who wrote this letter, looking for this person, calling on the phone number provided in the letter, and asking very basic question. What they are asking? They are asking exactly why on the last 2 pay stubs less hours. And if they confirm the story, that person was vacation, child sick, no problem. Everything approved. 160 hours will be approved. But if bank calling and they say, oh, you know what, we are slow now, we don't really have too much hours now. Interesting. In your letter you said you guaranteed 40 hours weekly. So how many hours you actually guaranteed? Oh, right now we guaranteed just 30. Ta-da! Bank will recalculate everything based on 30. So please be careful. So if you're working with mortgage professional like myself, I will discuss it with you, and please be honest. Like say true. If it's because something slow, or factory slow, or your employer is slow, so it will go by 30, it's better that your boss will write honestly whatever is actually happening. Okay? If you work no right now no more than 27, ask boss put on the letter 27 hours weekly, okay, or whatever is bi-weekly, okay, it's important. I hope, Oksana, I answered your question, and I don't see any other questions, so I will continue with our presentation. Penalty. So here is an example. I compare here between Merrick's bank. It's one of the monoline banks. Again, I'm not saying you must get mortgage from Merrick's. I'm not saying you must get mortgage from any bank. I'm not advertising right now, okay? So full disclosure, I'm not advertising right now Bank Merrick's or any monoline bank or any other bank, okay? It's just information that I received. It was in my email. I received this comparing analysis between Merrick's and any other bank, okay? So not any, like not all banks of Canada. Let's say compare, this is table comparing between Merrick's and one of the big banks, okay? We will not say what is a bank because we don't want to disclose it here, okay? But like what is going on? Why we should speak about penalties? Why we should think about penalties? Let's say I'm going to get a mortgage, okay? And I already know that big banks can provide good interest rate. And I went to the bank, and let's say bank provided me with the interest rate 4.44, and I'm happy. And I probably will pick this bank. I called my mortgage broker says, I have a Merrick's, right now Merrick's giving 4.54. And I'm saying, 4.44 is better than 4.54. And I decided to go this direction. I decided to take 4.44. 1 year pass, 2 year pass, maybe, I don't know how long. Let's say after several years or after several months, for any reason, I decided to break mortgage. It can be thousands reasons why people break in mortgage. Divorce, separation, somebody decided to return back home. For any reason, you may want to break your mortgage. Or it can be very simple in reason, like right now interest rate 4.44, in several months or couple years interest rate will be 3.3. You want to break. Why you want to break? Because you want to get better rate, but you will pay penalty. So I need to think about this penalty now, because maybe I will pay, my mortgage payment will be like 20, 30, 40, 50, maybe even $100 lower now, but maybe I will pay 1,000 after if I will need to break. If you look on statistic in Canada, 60% Canadians breaking their mortgage in approximately 2-3 years period for multiple reasons. Selling one home, buying another one, moving from one province to another province, divorces, want to get better rate, want to refinance, get better financing from any other bank. So many reasons why you want to break mortgage during the first term. So let's say you break your mortgage, and let's say in this example the new rate is 4.34, okay, 4.34. But when bank provided you with 4.44, original rate or posted rate was 6.49. If you go on website, doesn't matter what website, go to the website of RBC, Scotia, TD, CABC, BMO, on every website that you go, if look for posted rate. Don't look on promotional rate, look on posted rate. They're much more higher than the rate that bank advertise that they can give you. If they're giving you good rate, they remember about discount. And when they calculated penalty, they calculate penalty based on your discount. How they calculate penalty? Look, they're looking on contract rate. Okay, this is your contract rate, 4.44. They're looking on current rate. Let's say current rate 4.34. So difference is not big difference, just 0.1. They adding to difference discount. So discount 2.05% because they gave you 4.44. It's 2.05 less from 6.49. So calculating discounts and your interest rate differential is 2.15. So let's say you still need to pay $400,000 on your mortgage. If you multiply this $400,000 of your mortgage balance by this IRD or interest rate differential 2.15, you divide this by 12 and multiply by amount of months left. Let's say you broke your mortgage in 2 years, so left 3 years. 3 years is 36 months. So your penalty will be $25,800. Your penalty will be more than $25,000. And it's small rate difference. And if rate will be lower, you will pay even more penalty. Sometimes penalties can be like huge amounts, like $60,000, $80,000 penalty. Okay? So this is what happened in majority of big banks. If you like maybe thinking, oh, it can be true. Like all main Canadian banks doing this? Yes. And if you just after this presentation go and Google BMO posted rate, BMO current rates, CIBC posted rate, CIBC current rates, you always will see they're giving a huge discount. And the more discount they're giving, the more penalty will wait for you. It's basically mean if you will take a mortgage from one of the big banks and you will be locked for all 5 years, you will not be able to break. Why? Because you will not be able to afford this penalty. Or if you don't have a choice, you will need to pay all this amount. And sometimes this amount of penalty even bigger than your down payment. It's sad story. This is why Merix is one of the monoline banks, and many other monoline banks. And believe me, we have a lot of monoline banks. They offering honest rates. What it means honest? They say, we are giving you 4.54. Yes, we're giving more than your big bank. But let's say you need to break at 4.34. We don't give him any discounts. We don't calculate any posted rates. This is your difference. And if you calculate this difference, penalty just $2,400. So why I put here $4,540? In every bank in Canada, we have a law. And the law says, if you need to pay penalty, if your mortgage was fixed and you're breaking and you need to pay penalty, you pay or 3 months interest or you pay IRD. Whatever is bigger. Of course, in case of big bank, it will be IRD bigger and you will pay almost $26,000. Okay? But in case of monoline, IRD is small and you will pay $4,540 approximately. I put here 3M, it means 3 months of interest. Just interest for 3 months. How to calculate it? It's very easy. You take whatever amount left, $400,000, you multiply this by your interest rate 4.54, and you divide by 4. Why you divide by 4? Because you want to see only penalty for 3 months, not for entire year. And we have 4 3-month periods, this is why. So what is the difference? More than $20,000. This is why every client who comes and works with me, I'm always saying, do you want a little bit smaller rate or do you want fair penalty? If clients say, I don't care, I want the lowest rate, no problem, get the lowest rate. What do you know? Do you understand that your penalty will be more than $20,000 if you will break? Yes, I understand. I would like to take a chance. And I can honestly say these people usually crying. They're not crying at the day when they get a mortgage. They're usually crying after that. And I actually asking every of my client sign a special letter if they say, yes, I understand risk of my penalty. Yes, I agree to take lower rate and pay huge penalty in case if I will need to break. Okay? Now, if my clients say, no, I'm fine, I prefer to pay a little bit higher, so 4.54, this is what client will get. In some cases, I can decrease 4.54, like 4.54. It's just an example. Of course, I hope everybody understands we are speaking about examples. It doesn't mean that everyone will get here 4.54. You maybe will get 4.24, okay? Because today some banks offering 4.24. It's just an example. So let's say you offer 4.54 and you wait. Why you wait? Because possession not today, possession in a month or 2 months. And if an interest rate going down, you have a huge chance, if you work with me, to get even lower rate, because I'm always looking of all changes in banks, and if rate will decrease, you will get better rate. Okay, I expect questions, so I want to check if any questions is here. Okay, I don't see any questions, so I hope we can continue. Okay, again, if you will see or you will have any questions, please don't hesitate typing here. As you remember at the beginning of presentation, I provided with my phone number, so if you would like to ask me personal question on WhatsApp, please contact me via WhatsApp and I will be happy to provide personal consultation and help you with your mortgage needs. I'm afraid I didn't mention this from the beginning. So again, my name is Boris Sapozhnikov. I'm a mortgage professional. I'm working in Canada. I can help you in any province. So if you live in Montreal, or if you live in Calgary, or if you're from Vancouver, BC, or Toronto, or from Winnipeg, like I am from Winnipeg, I will be happy to help you with any mortgage needs that you may have. So, and let's continue our presentation. So we just spoke about the penalties, and I hope it's clear how penalties works and closing costs. Banks usually ask and check that you have 1.5% on the top. So let's say you buy a home for $400,000. You need 1.5%, so 1% is 4,000, half is 2,000, so you need $6,000 for closing. This closing will go to pay a lawyer, to pay appraisal. Appraisal is a person who checks the price of the house. It's not always required, sometimes it's required, it costs money. Any taxes, land transfer tax, again, maybe in your province it's not really expensive. In my province here in Manitoba, it's expensive. So all this, any adjustments with the taxes, like municipal taxes or anything else, all this costs money and you will need to pay to your lawyer. like you give this money to your lawyer, and lawyer take certain fees for himself because lawyer fees, and all other money transferred to the tax like to the taxes, adjustments, or any other fees. But your bank usually will not talk about that this cost can be 2% and can be even 3%. So it depends by province. Let's say if you're in Ontario, probably your closing costs will be up to 3%. But if you live in Manitoba, your closing cost will be approximately 2%. But if you live in Alberta, your closing cost probably will be around 1.5%, maybe even lower. Okay, I'm going to check if you have any questions, and if no questions, we can continue. Okay, I can see a question. Okay. A question about checking account. Let's say we have a checking account and we have some transactions in a checking account. And this transaction happened in the last 6 months. And question, if bank may ask about source of this transaction. Of course, bank may ask. Can I guarantee that bank will ask? No. So basically, I don't have 100% answer on this question. So I need to see your checking account. I need to see what types of transaction you used. Of course, if there were like some cash deposits, let's say you worked in the restaurant and you're getting some money like tips as a cash. You accumulated this cash and you brought it and you deposited in your checking account once or twice in the last 6 months. It will not be any problem here. So it's very, very specific question. I cannot answer on this question generally, but if you're generally asking, I have transactions on my checking account in the last 6 months. Will bank ask me about all these transactions? Yes, bank may ask. May ask, may not. Again, if you work with a mortgage professional now, like myself, we will go through all these transactions and we will build or create explanation letter explaining the bank the source of these transactions. Okay? So answer on the question, yes, bank may ask. What to do to prepare or be ready to explain all these transactions. Now, this is like general. No, you don't need to afraid because majority of transactions can be explained and usually it's not a problem. Okay, let's go next. You probably heard about homebuyer plan. Is if you have RSP account, an RSP account usually you have when you start to work. So you started to work and you're doing taxes, and CRA who checked your taxes providing you with a room based on your income. So the more income you have, the more room you have in your RSP account, and you can put some money in RSP account. So it's just an examples of that you can withdraw amount of $35,000. You can use funds after 90 days. But again, RSP is not really popular, so I will not talk about this account too much, but I would like to introduce you with one interesting method. So sometimes people don't have enough funds to pay for down payment, or don't have enough funds for closing costs. But you're eligible to take loan in the bank. So you can take loan, and the goal of this loan can be invest in your RSP. So you can take a loan, invest money in your RSP account. You can wait 90 days. So 3 months is the period that banks required. And after this period, you can use money from your RSP account to purchase your home. So basically, you borrowed money for down payment, but you borrowed them for your pension program, and Canada government allowed you to take money from your pension program and use them for down payment. Now, why I put here you need mortgage professional, like in the highlighted this in red, because you need carefully calculate everything, because if your income is not covering or is not big enough to cover loan and a mortgage, all this plan will not work. So this plan works for people with a good income, and it should be calculated and it should be checked if this person can use this maneuver or home buyer plan maneuver. Like sometimes people ask me, what do you mean by good income? Good income is even $50,000 good income, like 30,000 good income. Like it depends what do you want to buy. If your income is 50,000 and you want to buy something for 200, your income is good. Why? Because 50,000 times 4 is 200. So it's kind of normal to buy, like if your annual income is 1/4 from whatever you want to buy, is considered good income for mortgage or enough. Okay, it's like instead to calculate with special formulas, this is an easy formula that you can have in your head. So if you want to buy a house for $100,000, like $400,000, okay, you want to buy $400,000 house, your annual income should be approximately 100. Like if you working, your husband working, plus children money, so all this money calculated in total 100,000, you have a good income. You don't have enough for down payment, you maybe can borrow some money. I should calculate, or any other mortgage professional may calculate for you how much you can borrow and how much you can afford in order to get some loan that you can in the future use through pension program as your down payment. Okay, I just want to double check before I'm starting to talk about credits. I want to check if any questions is here. Okay, I just see here answers like thanks. Yeah, thank you very much for participating. Yeah, I will send a smile here because I want people participate. Okay, so please not just watch my presentation, ask questions. Okay, thank you. And yes, okay, so another thing, many people don't know this. If you buy property in 2024, like right now we are in 2024, and you buy property, you're eligible for non-refundable tax credit rate of 15% from $10,000, or basically you're eligible to get back $1,500. So what does it mean to you? Like let's say you owe taxes, let's say you owe $2,000 in taxes. So you can get reduction up to $1,500. So basically, instead of owing government $2,000, you will be giving government less money because you're first-time home buyer. So I don't want to talk about this again too much. If you will buy a home in 2024, please, when you're doing your taxes in 2025, speak to accountant, let him know, her know that you just purchase a home and they know how to use this program, first time home buyers tax credit. It will help with your taxes. Okay? Again, if you don't buy in 2024, you buy in 2025, you can get this money back in 2026. Okay? Before I start to talk about FHSA, I just quickly check questions. I don't have any questions here, so I go with FHSA. I will say it's kind of almost mandatory. I'm not saying mandatory, okay, mandatory is not like too strong word, but I will say I strongly recommend to have FHSA account. FHSA account was first, they started this account in 2023. And a fun fact, many banks were so confused about this account, so even were not allowed people to have this account. I had cases when my clients went to the bank and say, I want to open FHSA account, and they were told, this account does not exist, or they were told, no, we don't have this account, or no, you're not eligible for this account. Okay, it doesn't matter if you're on work permit, you're permanent resident, it doesn't matter how many months or years you're in Canada. Everyone who is on work permit, permanent resident, you are paying taxes, you are working here, you're eligible for FHSA account. Even if you're like your income, even if your income is zero, you are eligible for this account. This account basically works like two accounts, TFSA, RSP. I don't want to talk too much. I just want to say you can put in this account maximum $8,000 per year. So we are almost at the end of 2024. Please, if you don't have this account, open it now, put 8,000. If you are going to buy in 2024, you will be able to pull this money back and you use this for down payment. Why it's good? When you will go to your accountant in 2025 and you will explain to your accountant that you use this account in 2024, your accountant will be able to reimburse you or give you money for that you use this tax account. Okay? Because this account is tax deductible. Okay? It depends by your province, it depends by how much you make. Like I can say, if you make approximately 50,000 in a year, you probably will get back approximately 2,000. It's free. I will say free is not a good word, but I will call this, it's a present from the government of Canada for first-time home buyers. So you had 8,000, you was making around 60,000. You put 8,000 in your account, and you basically, just by using this account, you got a present from government of Canada, $2,000, because you purchased home in Canada. So this is one more instrument that the government used to encourage purchases of your own property in Canada. Okay, rents going up, rents never going down. Like you can find maybe worse rent, or you can move, let's say from Ontario to Saskatchewan, and of course you will pay less rent. But if you live in the same area, in the same town, in the same province, your rent will go up and up and up and up. Government wants that people have their own properties, because these properties will help people to build equities. Equity, it's amount of money that basically you can cash if you sell your property. Why government interested for you doing this? because government not taxating your own property. So if it's you're buying property for yourself, let's say for $100,000, and you sell this property after 20 years for $200,000, all this gain, all this extra $100,000 that you gain because you sold your property, all this money is yours, no taxes. Okay, so why government interested in this, that you will have your own property and you have money? Because when you will be old and you will have some equity or you will have some cash from selling your home, you basically will be able to continue happy live, and you will be less dependent by government. Okay, so by helping now, giving you 2,000 by this that you used your 8,000, government planning like forward, making sure that you have, hopefully that you will have your own property. Okay, it's kind of a plan in Canada, like it's kind of standard, like you buy something, let's say for 200, and you after maybe buy something for 300, and after you buy something for 400, and you sell this hopefully for 600, and when you sell this for 600, you can move into the apartments that maybe cost 200. I'm speaking about small provinces, I'm not speaking about right now, not about Ontario, okay? So you will move in some small room in some small property. So, and all this difference between 600 and 200, $400,000, because you paid off your mortgage after 20, 25, 30 years. You, of course, you can pay off your mortgage even faster. All this difference you can use, it's your money and it's not taxable money. Okay, no tax, you don't need to pay taxes from this. Okay, so maybe some questions here. Let me check your questions. Okay, I have questions here. Okay, I must translate it in English. So, okay, why some specialists recommend take mortgage for 25 years, even if you have cash? Like, let's say you have 100%, you have cash, and you can buy a property. But some specialists say, oh, you don't need it. Like, why to buy property for cash? It's better to get a mortgage. Like, some specialists recommend to do this. And people taking mortgage for 25 years, and for 15, during the 15 years, people pay off, let's say pay off their mortgages, and let's say they spend 50% from whatever money, like I understand this question, like it's basically, it means, like, let's say, okay, I will give you an example. Let's say you purchase a property that costs $100,000, okay? And you took a mortgage and you paid 15 years, and of course you paid not just whatever you borrowed, 100,000, you paid also interest. And let's say interest was 50%. So you purchase property for 100,000, and you, after 15 years, you spend 150,000. So why some specialists say it's not that it's good, but from our perspective, it doesn't make any sense, because if I can buy for 100, why I should take mortgage? Okay, this type of specialist called financial advisors or investors. It's not the topic of this conversation, but I can explain in 2 words. If you take out a mortgage, let's say 4%, okay? I have a mortgage 4%. And all this money I invest somewhere and I make 7%, so I'm making a difference 3%. So in all North America, not just in Canada, in the United States as well, rich people, not people like newcomers or not people like normal, or like normal maybe bad word. Like, let's say average person cannot afford it, but rich people, okay, like President Trump, who wants to be back president, okay, rich people who invest in buildings, yeah. So these people, they're taking mortgages. They love to take mortgages. Why? Because they can make money somewhere else. So the specialist or financial advisors that recommend to take mortgage, they recommend them to take because they believe you can make more money somewhere else. That's it. Another question. We arrived in Canada in 2023. In 2024, open FHSA. We put $8,000 in 2024. They would like to put another 8,000. Unfortunately, no. You arrived in 2023. Unfortunately, you opened FHS account in 2024. You can't go back and put for 2023. Okay? So, yeah, this account is kind of tricky. Like when you open, you can put money. And next year you can put money, and next year you can put money. But you cannot put money for the year before. Okay? Yeah, so unfortunately, Vita, answer to your question, no, you can't. Maxim asking another question. What's the difference between TFSA and FHSA? A huge difference. TFSA is tax-free saving account. It's basically you put money and you don't pay taxes on this account. That's it. It's very simple account. Like, let's say I have $1,000. I put it in TFSA. I invested inside of GIC, like 4% interest. I made some money, okay? And whatever money I'm making there, like let's say I invested in Bitcoin, I can invest whatever I want inside of TFSA. And let's say I made money, and I can take this money together with whatever investments I got, no problem. So I can basically make money and I'm not paying taxes for this, okay? So if I make money inside of TFSA, I am not paying taxes for making this money, okay? I'm not paying taxes for income inside of TFSA. FHSA has the same option, but in addition, because it's for first-time home buyers, it's actually work as RRSP. What do I mean by RRSP? It works as tax deductible RRSP. So I put 8,000, my income 60,000, 50, 60,000, government give me back 2,000 from my taxes because I invested in FHSA. You don't have this option in TFSA. So again, TFSA is simple shelter, okay? You put money in TFSA, you made more money in TFSA, it's income, but you don't pay taxes on this income. FHSA has exactly the same option as TFSA. You put money, you made some money, you got some income, and you don't pay taxes. In addition, FHSA works as a RRSP because it has function tax deductible. You will get money back. The presents that I spoke about from the government, of course, like 2,000, it's like, please don't go to your accountant and say, please give me 2,000. No, it doesn't work like this. I just said approximately. It depends by your income. It depends by taxes of your province. You maybe will get more than 2,000. Maybe will get less than 2,000. But you will get some money from investing money in FHSA from the government taxes. You will get from your taxes, like you pay taxes, all 2024 you pay taxes, you put 8,000 in FHSA, in 2025 you're doing your taxes, some of your taxes will get back to you because you invested in FHSA. So it's a present, okay? Okay, I want quickly check if I have more questions. Okay, yeah, I see. Thank you. Thank you for your questions, guys. Another smiling for you. Okay, let's move forward. Okay, we are very, very close to the end of our presentation. I actually planned to do just 1 hour. We are almost already hour and a half here. So quickly about B lenders and C lenders and why we need them. So we have all big banks, okay, 5 big banks. We have credit unions, okay. We have credit unions, many credit unions. Different provinces have different credit unions, okay. And we have monoline lenders or virtual or online lenders, okay. So when we have all these banks, all these lenders, we are talking about standard or A lenders or A banks, okay? A category, best category. This is like kind of standard. We spoke about differences in penalties. We spoke about some tricks that different banks may have. But why do we need other type of lenders? They're usually monoline lenders, some special monoline lenders. They call B lenders and C lenders or private lenders. Let's say you have a lot of money, 20% down payment, okay? And these lenders are not regulated federally. So it means they can be more flexible. Let's say you make $100,000 and you go to the bank say, okay, go and buy property for 400,000, 410, 420, something approximately, okay? 450, okay? But you want not 410, 420, you want 600, okay? Of course, bank say, no, federal law, I am doing stress test, I am checking your income. Based on your income, you're not eligible for 600. But you want, you really want. So B bank providing alternative, they may allow to go higher. So sometimes 5 times higher. So instead to buy house for 420, you buy house for 500, maybe even 520. So why we need C banks or private? These banks may go crazy and say, wow, I go crazy, I will give you 600. Now, it's not for free. If you speak to B bank or C bank, you will need to pay. Usually minimum 1%. Let's say you're borrowing $400,000, you need to pay $4,000 cash for using these banks. And it's minimum. I saw cases when some banks ask for 3-4%. So let's say you won't borrow $400,000 with this bank, private bank, you need to pay $16,000 or $12,000 just because you want to buy something that you actually cannot afford. Okay, so when we use these banks, if you want to buy something that you actually cannot afford. You're self-employed. You come to Canada, you decided to open business, you open very beautiful, interesting business, you have huge income, you make thousands of dollars, okay? But businesses usually need to show in normal, like not normal again, bad word, in the A banks usually need to show that your business survived 2 years. But these banks say, no, you don't have to. Let's check your last 6-7 months. You good? Okay, I'm fine. Take this mortgage. So they can allow things that normal banks not allow. They can take even people with a low credit score, like as low as 550 or even no score. Like what do I mean by no score? like 300 score, 320. No score, it's mean for me, it's like 300, 320. Really bad behavior, bad credit score, people spending money. Even these people deserve to get mortgage. If they want, they will, and if they have cash, they can get a mortgage. Okay? Again, I don't recommend to use these banks, not because I don't like them. I am working with these banks. They're very good partners with the mortgage brokers. But if you can afford something and use a bank, just buy something that you can afford. Sometimes clients say me, Boris, you know what? If you will, like, I know that I can afford just 300, but please make something and give me 450. I say, okay, we can go to the B bank. But person say, oh, I don't have 20%. I say, okay, so you don't have a choice, or you need to make 20%, or you should have a better income, because this is how it works. You maybe heard in the news some brokers doing documents for people. It's called fraud in Canada. I'm strongly recommend, please don't use these people, because fraud is not good. Because the more fraud in Canada in mortgages, the more documents required from regular people. Okay? So yes, so this was a little bit about B and C lenders. I will quickly check if questions here. I don't see questions. No questions. And my next is about rates. Okay, so this is basically my last part in this presentation. People always thinking about rates, and as we previously discussed, sometimes it's better to have a little bit higher rate but have a much lower penalty. It's better to pay if you need. It's kind of low to have insurance. Okay, let's say you got a little bit higher interest rate, and you pay a little bit more, but you kind of feeling good. Why? Because you know, if tomorrow you need to break mortgage, you break it and you do whatever you need to do. You're not scared, oh no, I can't break this mortgage, I will pay $20,000-$30,000 penalty, I can't afford it, so I must pay whatever I must to pay. So yeah, so we already spoke what can influence on rates. Is like different sort of penalties with different banks. And again, I'm not recommending any specific banks because I don't know your personal circumstances. It's just general advice. And many factors like can influence your rate. So if you like start shopping right now and you need to buy and you need to close as fast as possible, like financial condition in 2-3 days, possession in 2-3 weeks, you probably will get whatever rate will be available, you will get it. But if you have more time and you can wait and take possession maybe in 3 months, you can observe as rates going up and down and maybe catch a moment together with your broker when rates will be lower than when you started and get much better rate. So time very important. Fixed or variable rates is completely different. Credit score or credit history can influence. Recently, I posted a video because many people were arguing with me online and saying, oh no, you don't need a good credit score, like 600, 680 is enough, 720 is enough. And I posted a video where I showed how banks ask for credit score for 800. So I'm not saying that everyone should have the score, but in some cases, bank may ask you for much higher credit score, like 800, 820, if you want much more lower interest rate compared to other banks. So some banks will come with promotion and say, I'm giving today 4.2, but I want you to have credit score 800. And if you don't have, you cannot use this promotion. So credit score, important. Employment type and income is important. If you have guaranteed hours, it's very important. If you don't have guaranteed hours, and we need to calculate average of 2 years, your interest rate may be influenced on this one. Loan size or mortgage size. If you have bigger mortgage, you usually can be able to get a little bit discount on rate. It also depends by the size of mortgage. So, and some other factors. I don't want to talk too much about every factor. You can easily read, like maybe I will just talk about GDS, TDS. GDS, TDS is basically how much you borrow. GDS, it means how much you borrow for the house. TDS, it means how much you borrow for the house and for car, for example. So if your house and a car 40% from your income, gross income, you kind of okay. But if it comes to 44%, you're borrowing too much, your interest rate can go lower. Your interest rate can go higher. So if you're borrowing, if you're borrowing just for the house and you don't have any car loans, anything, and you're borrowing under 32%, you probably will be eligible for much lower interest rate compared to someone who has 39%. Like let's say person doesn't have car but must borrow 39%, his interest rate can be higher than somebody who borrows just 32% from his gross income. Okay, some other factors, but you probably notice that I skipped first line, red line, availability to buy down the interest rate. If you go to the bank, unfortunately, mortgage specialists will say they never heard about it. Or they usually say, it doesn't exist in Canada, but it exists in the United States, and usually laughing. Of course, it exists in the United States, and you can go into the bank in the United States and buy down interest rate. So you pay money and you get lower rate. But why I put it anyway? Because mortgage professionals licensed in Canada can use their commission to buy you interest rate. Again, mortgage brokers, mortgage professionals licensed in Canada with license, okay, not just some specialist who is not licensed, okay, licensed in Canada, can buy interest rate for you using their commission. They cannot use your money, they're using their commission. And now I just want to quickly stop what I am doing. So first of all, I will never ask money from you, except if you want to use private bank. Like maybe you remember B bank, C bank, I don't have a choice. You will need to pay a fee 1% for the bank because you're using very, very special bank. But if you are not with your kind of standard bank, A bank, big bank, credit union, or monobank, any one of these banks if you are using, I am as a mortgage broker, I am allowed to buy down your interest rate. So for example, you go to the bank and bank say, okay, I will give you 4.4. The same bank can give me 4.3. Why? Because I can buy this difference, 0.1. How I'm doing this? I'm using my commission. How frequently I'm doing this? I'm always doing this. So basically, by working with me, I cannot promise you that you will have the lowest rate in Canada, not because I don't have access to the lowest rate in Canada. Maybe you are not eligible for the lowest rate in Canada. Maybe your score not 820. Maybe you picked a loan size that's 39%, not 32%. So you want bigger mortgage, not smaller mortgage. So depends by many other factors. Maybe your interest rate will be relatively high, but it will be definitely lower compared to others, because first, I will never take any money from you because I'm working only for commissions. And second, I'm always using my commissions to bring you a lower rate. Okay? So this is what I can promise, and if you like my presentation, please share it with your friends, because we are almost finished. I just want to check if we have any questions. I don't see any questions, so I will just wait several seconds, just double check, maybe somebody typing question. If you don't, or if you didn't have time to ask your question, don't worry. You can always write your questions in comments under my video. Okay, so please write questions in comments under my video, and I will come back to my video and check that your questions, and I will type back answers. Also share this video with your friends. It will be very useful. Okay, one more question. Okay, what is a better mortgage length? 15, 20, 25? Of course 25. Why? Because when you take amortization 25 years, you have guaranteed 25 years that you can do whatever you want with your mortgage. So you start to pay your mortgage and you decided to pay off it in 15 years. You can. More than this, you can pay off your mortgage even in 5 years. I have banks that I can build a contract for you, that in contract you will see this mortgage is for 25 years. This term is for 5 years. Client can use prepayment privileges and complete this mortgage 20% per year. It means basically if you can return 20% per year, you basically can finish your mortgage in 5 years. So by having a length for 25 as a standard, but paying whatever term you want, like 5, 7, 10, 15, you have a flexibility. Today you have money, you pay more. Tomorrow you don't have money, you pay less. Now, what another plus to having 25 years? It's not just flexibility. When you apply with longer amortization, you can get a bigger mortgage amount. The lower amortization, the smaller mortgage you will get from the bank, because stress tests will limit what you can get from the bank. Okay, so two main pluses by getting 25 years amortization. This is the most recommended amortization in Canada. 30 years exist, but not the most recommended. Even after December 15, 30 years will not be the most recommended. This will be just recommended, but not the most recommended. 25 years will be still the most recommended in Canada. Why? First, because of flexibility. You start to pay first year, you can finish in 5 years, 7 years, 10 years, 15 years. You can finish this mortgage whenever you want. It's not like in the United States. You took 15 years, you pay 15 years. You took 30 years, you pay 30 years. No, in Canada you take 25 years and you can finish in 7, 10, 12, 15, whenever you want. You want to finish in 3 years, you can. Take term in 3 years and finish after 3 years. You're flexible. You can finish your mortgage. You can even take mortgage in Canada for 6 months and finish pay for 6 months. So on a paper, you can have 25 years. On term, you have 6 months and you can finish all your mortgage in 6 months. So in Canada, we're very, very flexible. So flexibility, this is reason number one. Reason number two, the bigger amortization, the bigger mortgage you can get. This is why government says after December 15, take 30 years. So you can get bigger mortgage. You can afford bigger house. You start from the bigger house, you will sell and you will make more dollars. You will be more safe when you retire. Okay? I hope I answered all these questions. I answered the last question too. I would like to finish my presentation. If you have more questions, please type them under my video. I will make sure to answer all your questions. And yeah, I just want to send another smile. Thank you very much for your question, Eva. And oh, one more question. Thank you. Everything was clear. There will be additional question when, yeah, of course you will have, yeah, of course, Oksana, you will have additional questions. If you have any questions, the best, what I recommend, to get a professional one-to-one consultation with whoever is your mortgage professional. And yeah, if you want me to be your mortgage professional, I provided my phone number at the beginning. So please reach me via WhatsApp on my phone, 204-998-S349. And don't worry, at the end of the presentation, again, I will show the link to my profile. From the link to my profile, you can easily reach me. Yeah, again, I recommend use WhatsApp to reach me. And thank you very much for everyone who participated, and thank you very much for your questions. Okay, I am going to close. And I hope to see you guys next time.